to the McFadden Library for another scintillating scholar series. We have just one more left for this term, so let me quickly announce it so that we give people time to come in. Next month, April 24th, we're back to a Thursday, and we have Dr. Mark Scott on a really intriguing title which says he's just published a book on the beauty of souls, which is the aesthetic encounters with Marilyn Robinson. So he's sort of combining, I think, a whole bunch of spiritual wisdom, philosophy, theology, and literature. So it should be certainly very thought-provoking. Mark Scott will certainly advertise it later. But today, and one more thing, Jack is going to be filming this, so just so you know, it'll be coming on Easton Cable. I'll say the old thing that I've been saying for 20 years. If you're on America's Most Wanted, now is your moment to leave, but it will be on Easton Television shortly, after which Garrett will be putting it on the college archives.
What if you're America's Least Wanted?
There's so many of those, right? All right. Professor Sim, are you ready?
Yep.
Okay. So we're absolutely delighted to have Dr. Khai Sim with us today. Dr. Khai joined Stonehill College, stop me if I'm wrong, in 2023 as an assistant professor of economics. And before that, he was at the Easton Connecticut State University as the assistant professor there. And before that, he was at Cornell University. You were a teaching assistant while you completed your PhD, but you also taught at the Cornell Prison Education Program. You were not an inmate, but you did teach, correct? Wonderful. He got his Bachelor of Science at the University of Michigan in economics, in statistics, and in actuarial mathematics. Numerous publications. This is his most recent, so we read this out right there. So when you're having your coffee, you can read it. Journal of Macroeconomics has a bunch. Journal of Mathematical Economics. The Economic Letters, very impressive. Numerous awards. The Outstanding Teaching Award in Cornell. You forgot that, but
yeah,
it's there.
I did forget.
A Sage Fellowship, also at Cornell. And I love the best paper at the Finance Association Conference in 2020. Wonderful. I've also been told by his students that he brings great joy to his classroom, and by his colleagues, same reaction. I know I get great joy because Professor Sim walked into my house, took one look at my display of glasses and said, "That's from Costco. We are Costco buddies." That's where a lot of your stuff has come today. Professor Khai also speaks many languages: Mandarin, Malay, Cantonese, computerese, mathematics. But today you're going to stick to English, correct?
I will try.
With a bunch of maths that's thrown in. Hopefully less, because I won't understand it. So if you don't mind, if you can just introduce just a formal introduction of yourself for television, and then we can proceed.
Okay.
Yeah.
So my name is Khai Sim. I am an assistant professor in economics at Stonehill College. I started here about 2 years ago, and my research is mostly on bank failures and monetary economics. Okay. So I study, my research mainly focuses on why banks fail and mostly how to prevent banks from failing through different types of financial regulation. Okay.
Yeah.
Okay. Shall I start?
You're a little soft, Khai. Can you just see?
All right. Should I keep using the microphone or can I?
You have another microphone, Garrett?
No, this is good. Yeah. All right, should I start?
Yeah.
Yeah?
Yeah, absolutely.
Okay, so the first half of the talk today, I'm just going to introduce this very recent Nobel Prize winning model that was introduced back in 1983. It was published in 1983, and I will try to strip down as simple as possible, and that is a very, very good and stylistic representation of to help us understand why banks fail and what are the different types of bank failures, okay? What drives bank failures. Okay? And then the second half, hopefully I will jump into some of one of my most recent papers and on bank regulation. Okay? So what is bank runs? Okay? Bank runs are basically when depositors go to the bank, a large fraction of them go to the bank and they withdraw their deposits within relatively short period of time. So that causes banks to run out of liquidity. Okay? That's what we call fire sale sometimes, and that is when they run out of reserves, so they have to sell some of their assets very, very quickly, usually at relatively low price, because a lot of other banks and other buyers are going to be skeptical about the quality of those assets, okay? And that causes them to fail. Okay? So the two major types of bank runs, the first one would be what we call fundamental driven runs. Okay? So these are really caused by some of the bad fundamentals of the bank. For example, insolvency, excessive bad loans, and also liquidity storage. So if they issue bad loans, and there's a lot of failure of repayments from, say, their borrowers. So that could cause a fundamental driven run. Okay? With the most recent example of, say, Silicon Valley Bank. Okay? So a lot of their depositors have been startups. Okay? And because of the recent economic situation, many of them started having difficulty raising funds through venture capital, so they have to start depleting their deposit to continue their operations. So a larger fraction of their depositors are withdrawing because they really fundamentally need those money. So that is why that's also considered fundamental driven run. Okay? The other type of bank runs would be what we call the panic-based bank run. So this is really driven by expectation and beliefs. If you believe that other people are running to the bank to withdraw their funds, you know that there's a high likelihood that the bank is going to fail. So you, even though you might not need the money right now, you will also run to the bank and withdraw. And that causes what we call panic-based bank runs. So it is caused by irrational fear or rumors. Okay? So a lot of times, most of the bank runs that we observe, especially lately, is usually a combination of the two. It's usually started with some bad fundamentals, including the most recent Silicon Valley Bank episode. It started with because all those startups needed some liquidity. And then they started looking at their assets to see which kind of assets they can sell. And then the unfortunate situation is that most of their assets are in very long-term treasury bonds, and at that time, because of the high interest rates, their prices are really low. So they needed to raise more capital, and that raised their attempt to raise capital has triggered the fear of all the other depositors, all the other startups that deposit with them. So it started as a fundamental driven run, a little bit of a bad fundamental, and then it triggers the other type of bank run, which is panic-based bank run. Okay? So these are the two major types of runs, and I guess the structure of the panic-based bank run is basically captured by this very, very simple and beautiful model that was introduced by Diamond and Diffley, who won the Nobel Prize for this particular model back in 2022. So I will try my best to explain this in the simplest format that could still capture why banks fail. Okay? So here is a bank, and say we have, so you have 8 beautiful depositors. Each of them has $100. Okay? Very, very simple environment. Okay? Everybody has the same amount. Of course, it's not realistic, but this is just sufficient for us to understand why banks fail. Okay? So what happens is that these people, okay, we think about them as very short-lived. They only live for 3 years. Okay? After 3 years, they die. Okay? So in year 0, every one of them has $100. And then they will put it in the bank, and after 1 year has passed, in time 1, they can decide whether they withdraw or not. Okay? If they decide not to withdraw, at time 2, they can withdraw whatever that is left in the bank. Okay? So nobody will want to withdraw anytime after time 2 because they die. Okay? So very, very simple environment. Okay? You have some choice as a depositor. Okay? You have $100, you put it in the bank at time 0, and at time 1, you decide whether you withdraw or not, okay? Based on your need. Maybe you have a toothache that you need to go to see the dentist, you withdraw the money to go to pay for the medical help. Okay? So what the bank offers, say, very simple, 10% interest rate, which means that if we deposit $100 at time 0, okay, how much do we get at time 1? $110, a very simple calculation. At time 2, if you waited for 2 years, 10% is going to compound again, and it becomes $121. Okay, so this is kind of like the deposit contract that you indirectly agree to whenever you put your money in the bank. They tell you your saving account is going to give 4.5% interest, and this is basically what's happened. Okay, so you don't just live for 3 years, but if you were to live just for 3 years, this is what you should expect. Okay? So let's see what happens. At time 0, all of these people put their money in the bank. Okay? The bank has $800. What do they usually do with deposits? They make loans. Okay? They purchase a lot of different types of assets. Like if you look at modern financial institutions, it goes from the most liquid, basically is reserves, basically cash, free cash flows, all the way to sometimes very, very long-term, very, very highly securitized, complicated assets. Okay, so for simplicity, we're just gonna look at a very, very simple loan. Okay, a 2-year simple loan at 10% interest rate. So think about it as like the mortgage that they issue for some kind of borrower to purchase a house. Okay? A lot of times these assets are longer terms. Okay? Like in this case, the long term is just 2 years, 2 times. Okay, so what happens is that the repayment after 2 years, okay, for whoever that borrows $800 from this bank is going to be $968. Okay, so you take the $800, you multiply by 1.1 and 1.1 again because 10% interest rate for 2 years, and then eventually in 2 years, the bank should expect $968 of repayment. Okay? So the other option is that this loan can also be sold at time 1 because at time 1, it's not the due date yet. Okay? But that promise of $968 can also be sold at time 1 to other banks at face value. So that's, again, very simple assumption, but in reality, this is what we call sometimes fire sale, when they really need liquidity and most of their assets are long-term assets and they need to get rid of them very, very quickly. And a lot of time that has resulted in very, very high depreciation on the value because other people are skeptical. Why are you wanting to sell all of your long-term assets? Are they bad? Okay? So a lot of times the prices are very, very heavily discounted. So in this case, we're not going to assume that much discounting. If they were to liquidate, they can liquidate at whatever loan value that is. Okay? So later on when we start looking into the calculation, we'll see what it means by the original loan value of liquidation. Okay? What happens next? So at time 1, okay, what happens, some of the depositors are going to say that they want to withdraw. Okay? So these are people who have toothache and they need to go see the dentist. Okay? So they need to withdraw whatever that they have deposited. This is an emergency. Okay? So this is exactly what us as depositors do. We put money in the bank and then we should be able to withdraw whenever we need the money. Okay? So in this case, 2 out of 8, let's say, hypothetically, 2 out of 8 of them decides to withdraw. So what does the bank do? They have to sell $220 worth of their loan out of 800. Okay? Because each of these depositors, they deposited $100 at time 0, so now they're entitled $110 at time 1 if they choose to withdraw. Okay? So the remaining loan value out of the 800, once they have liquidated the $220, which is that they sell $220 worth of loans to other banks so that they have enough cash to pay these 2 depositors who wanted to withdraw at time 1. Okay? So that's how much they have left. Okay? They have $580 worth of loan, okay, left in their asset. Okay? So that is time one. So each of these two depositors get their $110. Okay? So now we move forward to time two. Is it moving? All right. At time two, out of the $800 worth of loan value that's remaining, okay, the bank is expecting to receive $701.80 in loan repayment. So this is coming from the $800 of loan that they initially made. They sold 220 of them at time one to liquidate so that they can pay the two depositors who just withdrew. So the remaining amount will be 580. So you compound that by 10% interest for 2 years, that amounts to $701.80. Okay, so that's how much they have. Okay, so hopefully these amounts on the left-hand side, they all add up to $701.80. Okay, so what happens then? Okay, remember after 2 years, after the third year, everybody dies. Okay, so the remaining 6 people, they are definitely going to come and withdraw. Okay, so we are splitting or distributing evenly the remaining amount, the $701.80, across these 6 people who hasn't withdrawn in time one. Okay, so each of them should expect $116.97. Okay, so let's redistribute these green bills. Each of it is $116.97. And then we distribute that to the remaining 6 depositors. So this is the good case. This is how banks should work. Okay? We, as an individual depositor, it is very difficult for us to lend our savings. So that's why financial institutions exist. And this is like kind of a partially risk sharing. Okay? So if you were to issue a simple loan yourself of $100, and in time one you needed those money, there's nothing you can do. Okay? You have to wait for 2 years. But then if you put your money in the bank, they pull all $800 together. Not everyone is going to withdraw at time one. Okay? If you choose to withdraw at time one, if you need the money, then you can. Okay? So this is kind of the benefit of depositing in financial institutions. You hedge against the liquidity need that you might require, okay, anytime you want. Okay? So the reason here everything is good is because all of these people, can you see the cursor? Can I move around, or can you guys hear me still? Yeah. So the reason this works well is because all these 6 people at time 2, when they withdraw, they are distributed whatever that's left. This is $116.97. If you were one of them, this is good because if this amount is higher than $110. Okay, so if going back to time 1, you know that 2 people are withdrawing at time 1. There's no reason, if you don't have a toothache, if you don't need the money right away, there's no reason for you to withdraw at time 1. You will always wait until time 2, so there's no bank run in this case. Okay, so this is the best case scenario. Yeah. So let's look at what happens in a different case. So we restart this entire process. Okay, all the $100 they're going to deposit in the bank at time 0. And then time 1 comes, 5 people are withdrawing this time. Okay? So 5 people happen to need money. So this is equivalent to Silicon Valley Bank. A lot of the depositors, which are mostly startups, needed liquidity. Okay? So let's redo the calculation very quickly. They need to sell more loans now at time 1. They need to sell $550 worth of loans in order to fund these withdrawals. Whatever that's left is $250. Okay? So they only have $250 left. Okay? And then now we go to time 2. Okay? All these 5 people get 110 still. Now let's go to time 2. At time 2, the loan repayment is again whatever that's left, the $250, and then we compound it by 10% interest rate for 2 time periods. So the amount that they should expect to receive at time 2 from whoever they lend money to, it should be $302.50. And then we also redistribute these to whoever that hasn't withdrawn yet, which is the remaining 3 people down here. Okay? So dividing $302.50 by 3, each of them gets $100.83. Okay? So what is the issue here? If you know that 5 people are going to withdraw at time 1, if you're one of the 3, if you have waited like what they just did, you will eventually at time 2 receive $100.83. But if you compare that with the 5 people who withdrew at time 1 because they needed the money, they received $110. So now we can go back in time. If you were to be one of those 3, if we go back in time, back to time 1, once you know that 5 out of the 8 depositors are withdrawing at time 1, if you follow them and withdraw at time 1, you will receive $110. But if you don't, you wait until time 2, you will only expect $100.83, which is less. So what do? You also rush to the bank. Okay? So this is when bank run happened. So in this case, if all 5 of them really needed the money, just like what happened to Silicon Valley Bank, a large fraction of the depositors needed liquidity. This is considered a fundamental driven run. Okay? People actually need liquidity, and the banks do not have sufficient liquidity to provide them. Okay? So that's one type of fundamental driven run. So you can also think about other types of fundamental driven runs. Sometimes the assets that the bank invests in this case, which is a simple loan that they make, they issue $800 of loan and they expect them to pay back $968. What if they don't pay back? Okay, so that's also a different type of fundamental driven run. Basically, your assets become worthless, not necessarily worthless, but it's very heavily depreciated and you don't have enough asset to liquidate to satisfy all of your withdrawal demands, okay? All of the depositors that withdraw. Okay? So that's fundamental driven run. Okay? So in terms of panic-based bank run, what happens is that it doesn't necessarily have to be the case that 5 people out of the 8 have a toothache and needed to go to the dentist. Okay? You just have to believe that there are 5 out of 8 depositors that are withdrawing at time 1. Okay? Even if that's not the case. Okay? So this is when irrational fears come in and the panic comes in. Okay? In reality, it might not be the case that 5 out of 8 depositors are withdrawing, as long as everybody, all 8 of them believe that I don't withdraw, I don't need the money, but I know that there's a very high chance that 5 out of 8 of us is going to withdraw at time 1. As long as you have that belief, you are going to withdraw at time 1, and that causes a panic-based bank run. So again, in reality, what causes panic? Okay? There's always some kind of fundamental issues that start happening first. Okay? So if you still go back to the Silicon Valley Bank example, their assets are mostly in long-term treasury bonds and interest rate were high, so the value is low. That's the fundamental issue, and that triggers triggers them to raise capital, and that causes the panic. Okay? So if you realize that your banks are raising money out of a sudden, you probably perceive that as a signal that either many people are withdrawing, they are failing, so the best thing for you to do is to run to the bank. So that is what we call the panic-based bank run. Okay, so this is basically the basic structure of Diamond and Dybvig that won the Nobel Prize in 2022, and that's how the model that they used to conceptualize the framework for panic-based bank run. Okay? So what protections do we have, and what are the solutions to some of those panic-based bank runs? So one of the regulation that exists right now is deposit insurance. Okay? So if you were to be one of these three, okay, or either one of these 8 depositors, even if you believe that 5 out of 8 of us is going to we are going to withdraw, and eventually you're going to get less. But as long as you have deposit insurance, you know that your money is going to be safe in there, you are not going to withdraw. Okay? So in this case, it kind of eliminate most of the panic-based bank run. If you know that your bank is going to fail, but doesn't matter. We know that deposit insurance is going to cover your deposit. You don't withdraw at time 1. You only withdraw at time 1 when you absolutely need the money. Okay? So in the existing deposit insurance that we have, okay, covers is first of all provided by the Federal Deposit Insurance Corporation. So they are the ones that does a lot of bank oversight, and also they run the deposit insurance coverage. Okay, so a lot of times what happens when banks fail is that they sometimes act as a matchmaker. They look for other bigger banks to swallow the smaller bank that has failed, and that's how most of the bank failures has been handled in the past. Okay, so the current coverage of the Federal Deposit Insurance is $250 per depositor per insured bank. Okay? So do you have to be worried about your money in the bank? If it's over $250,000, then maybe you should be worried. Okay? And these are also cash. Okay? Like things that are in the covered accounts, checking accounts, savings accounts, okay? Some of the money market deposit accounts, and also certificate of deposit. So these are the ones that are covered under the Federal Deposit Insurance Corporation. Okay? So some of the things that are not covered, okay? Most financial assets, including stocks, bonds, mutual funds, and also some of the life insurance policies. Okay? So the $250,000 usually is sufficient, which is why we haven't seen a lot of bank failures and not a lot of panic-based bank run ever since the Federal Deposit Insurance Corporation has been founded. It used to be $100,000, and then after 2008, they raised it to $250,000. Okay, so very, very few consumers now have more than $250,000 in checking, saving, money market deposit account, or certificate of deposit within the same bank. So if you happen to have more than that, just go to a different bank, open another checking account, and split your money. Then you're safe. Okay? So, but this is not bulletproof. Okay, so going back to the Silicon Valley Bank, what happens was that the $250,000 deposit insurance is minuscule for startups. These are businesses. These are not individuals. These are not households. So the deposits are most likely much higher than the $250,000, and it's not covered through deposit insurance. So that is why panic-based bank run can still happen in a bank such as Silicon Valley Bank. So during the same episode, other than Silicon Valley Bank, there was also First Republic that also failed after that, and First Republic focuses on depositors and customers that have high wealth, and those people are most likely having more than $250,000, and that's a larger chunk of their deposit are not covered under the deposit insurance. Okay? So that is it. What time is it now? Okay, thanks. Perfect. So that's the framework that was introduced. A very, very simple framework, okay? Very idealistic, but it gives us a lot of understanding about why banks fail and what are the causes of bank failures, especially the distinction between fundamental driven run versus panic-based bank run. Okay? So the next half of the talk, I'm just going to focus on the most recent paper that I've been working on. Okay, so in this paper, I'm trying to look at bailouts. Okay? So we know that in 2008, after many big financial institutions have failed, the federal government stepped in, and there's a large bailout package that went out to save these banks. And this is taking a lot of resources away from taxpayers, a lot of governmental programs that can be funded cannot be funded because of bailouts. So eventually, a lot of the bailout monies from 2008 has been repaid, but there's many research that have been studying the actual opportunity cost of these lost funding. Okay, so even if they have been paid back, but they were not paid back until years later. Okay, so those are things that could have go to higher education, or for example, or healthcare, or any other public good that's more important. Okay? So some of the things that have triggered this project is, of course, going back to the 700 billion TARP fund that has been rolled out after the 2008 crisis to save all these troubled banks. Okay? And what happens is that if we keep doing this, banks are going to keep gambling on high-risk investments at the expense of taxpayers. So which means that you are taking unnecessary amount of risk because you know that once you fail, especially when they're big, they know that the federal government is always going to come in and save them. Okay, so this is basically, if things go bad, the taxpayers are going to come in and bail them out, but if things go good, they enjoy the high yield. Okay? So what my goal for this paper is that I'm trying to create a model that can investigate the effect of such bailouts regime, okay, to the portfolio choices of banks. So I'm trying to mimic what we expect, okay, which is if bailouts were to be allowed continuously, banks are going to take higher risk. So once that model is set up, I'm going to test on multiple different regulations and see what type of regulations can prevent that kind of moral hazard from happening. Okay? So some of the previous literature on bailouts and between bailouts and bank behaviors, you have this first one, which is studying the effects of bailouts on risk correlation. So they find that if bailouts were to be allowed, financial institutions have some kind of incentive to be very, very highly correlated, and that increases systemic risk. So if one bank fails, if they're very highly correlated, all the other banks are going to fail together. Okay? And then this other study, they said that large banks leverage more in face of the same bailout policies. So leveraging means that they are taking higher amount of debt, and that comes from allowing bailouts to, at least having the expectation that the federal government is going to continue with this kind of bailout policy. Okay? So there's also study on bailouts, the effect of bailouts on bonus and compensation scheme of financial institutions. And in the paper that's probably the most similar to this work that I'm doing is Bianchi in 2016. He studied the effect of bailouts on risk-taking, but not in financial institutions specifically, but on firms. These are like bigger corporations, like corporations that actually produce goods and services instead of financial institutions. So what I study here is that I'm going to allow bailouts, see what's going to happen to the behavior of banks, and I'm also going to restrict artificially the bailout and see if banks believe that they are actually not going to receive any bailouts, what would their behavior have been? Okay? By comparing these two, then we know the actual effect of allowing bailout, or at least the expectation that bailout is always going to be there. How is that going to affect the risk-taking behavior in banks? Okay? So the model construction is taken mostly from Diamond and Dipvig, okay, the one that we just saw. Okay, we're also looking at a 3-period model, very simple, 0, 1, and 2, and there's a bunch of depositors. Some of them is going to actually need money at time 1, but some of them do not need money at time 1. Okay? And I'm also going to add in a fiscal authority on this model. So there is going to be some kind of governmental figure that would tax some of the deposits and use that either to provide public good or to provide bailout. So that creates this costly bailout if they were to increase the amount of bailout, it has to take away resources from public good. Okay? So this is a very clever way by Keister. His first paper on bailouts and in this kind of environment was the paper that came out, I think 2016. Some places say 2015. I don't know why. Okay, so this I'm going to combine the model construction from these two major papers, and then what I added is the ability of banks to now choose the riskiness of their portfolio. Okay? So that is the new feature that I'm going to add to whatever keister that has already been constructed. Okay? So what are the main results of this paper? If we restrict bailouts altogether, it is also not exactly ideal. Okay? So even though bailouts, we know that it's going to induce risk-taking, it's going to make banks behave irrationally, that they're going to take advantage of those bailouts. But if we restrict bailout altogether, banks are going to become overly conservative. And overly conservative is also not great because you're giving up some of the opportunities for the higher gain from the slightly more risky investments. Okay? So bailouts do encourage risk-taking in banks, but banks become overly conservative when bailouts are restricted. So what are some of the regulations that we can impose, okay, to mitigate this risk-taking? Okay? So I have two policy solutions that could potentially bring the economy to the efficient level. Okay? I'll talk a little bit about what efficiency means. And if we still continue to allow bailouts and we impose one of these two policies, at least in this model environment, okay, we are able to achieve whatever the efficient outcome is going to be. Okay? All right. So what is the model? I'm going to just talk about the environment. I'm not going to solve the model. Okay? Don't worry about too much math over here. And then we'll look at what is the outcome. Okay? So 3 periods, we're familiar with this now, right? With all the cartoons that we saw earlier, 0, 1, and 2. Everybody lives 3 periods and then they die. Okay? So there's gonna be a continuum of banks. So many small banks, they think about this as a competitive market. Okay? And each bank is gonna serve, again, a continuum of investors. So these are the one of equivalent to the 8 people orange people that we just saw earlier. Okay? So instead of having 8 of them, now you have the continuum of them. So think about like banks having many depositors, and the behavior of one individual depositor is inconsequential, but a group of them is going to be consequential. Okay? So same with the continuum of banks. Like each bank is tiny. At least in this simplistic world, there's no large banks, but towards the end of the paper, I did extend it to include like 1 large banks, but the results remain relatively similar. Okay? So a continuum of banks means that the behavior of one bank, again, is inconsequential to the economy, but a group of them is going to be consequential. Okay? So each person, now, earlier they had $100, now they only have $1. Okay? Think about it, 1 unit of resource. This is your income that you're able to deposit into the bank. Okay? So you are going to deposit at time 0, and it's going to subject to some kind of tax. Okay? So this is when the government comes in. There's a governmental figure that I call, at least in the literature, we call fiscal authority. Okay? So we tax that, and the tax revenue is eventually going to be used for public good provision or bailouts. Okay? So fiscal authority collect taxes, provide public goods, and bailouts. So these are some of the notations. We don't really have to care about them that much. You just have to know that that's all the funds is going to go. Okay? So very simplistic environment, but it captures some of the opportunity costs of bailouts. Because if we don't bail banks out, there's lots of opportunities there's lots of public amenities or public goods that the government is able to offer with the same amount of money. Okay? So the main feature is that banks now are able to access two different types of investment. Okay? So this is the major extension from whatever whatever models that existed before. So there's a riskless asset that if you invest $1 at time 1, if you have to liquidate it, it's still $1, just like the example that we just saw earlier. But if you wait until time 2, you're going to get something that's more than $1. So this is the lowercase r over here. That is the return. Okay? Just like we lend out $800 at time 2, we expect $968. So the $968 is the lowercase r. Okay? And then there's also a risky version. Okay? Same thing. You invest $1 at time 0. At time 1, you can still liquidate it at $1. There's no return. But at time 2, there are two outcomes. Now it is risky. With certain probability, it's going to be give you really high return, which is the capital R over here. For the rest of the case, it might also turn out to have no return at all, just 1. Okay? So whatever assumption that we are making here is that the expected return of the risky asset has to be at least as high as the riskless asset. Otherwise, there's no reason to take on risk. Okay? So that's basically what you need to get out of this last equation. Okay? So the expectation of the return for risky asset is higher than riskless asset. So there is some benefit of taking risk. Okay? And if you look at the financial market, that's actually how it works. The riskier the asset, if market is fully efficient, of course, the more risk you take, the higher the expected return is going to be. Okay? So this is, again, the sources of why banks want to take risk, and also the reason why some level of risk is healthy. We don't want banks to take that away. Okay? So if you restrict bailout altogether, banks are going to take so little risk, and they're giving up the opportunity of the potentially higher gain from the risky asset. Okay? So just by having the choice of these two, you can think about them as, in reality, how well banks are or financial institutions are in hedging against all these different risks. Okay? So again, Silicon Valley Bank, a large portion of their asset in 30-year treasury bonds. That's not really fully diversifying. Okay? So that also is implying that they have a higher fraction of their investment on the risky version of the asset over here. Okay? So there are three, I guess, agents in this model. Okay? So three different types of people making decisions. There's the fiscal authority, there's the banks, and there's also the individual investors or the depositors. Okay? So next, we're going to look at what each of them does within this environment. Okay? So for the investors, okay, don't worry about all these symbols. Okay? They care about how much they get from withdrawals. Okay? So what it means is that at time 0, they invest whatever income that they have that they have available after paying tax into the bank, and then at time 1, they show up and we call them either becoming patient or becoming impatient. So impatient does not mean that they're actually impatient. Impatient just means that they really need money at time 1. You have a toothache, you need to go see the dentist at time 1. So that's why you need to withdraw. Okay? So people who are patient here means that you don't have a toothache, you don't really have to withdraw at time 1, but if you believe that the bank is going to fail, you might want to withdraw at time 1 too. Okay? So that's what it means by being patient versus being impatient. Okay? So after observing their time, whether they need the money or not, you wake up at time 1, you observe whether you have a toothache or not, whether you need the money right now or not, and then you decide whether you should withdraw right now or you wait until time 2 to withdraw. So this is, again, the exact same thing that we saw from the example earlier. All the depositors, some of them have to withdraw at time 1, some of them don't, but they can choose to withdraw at time 1. Okay? So now we also have the decisions of the bank. Banks have two decisions to make. One is how much risky technology they want to take on. Okay, so this lambda over here, okay, is the fraction of investment that they want to put into the risky version of the investment, okay, and then the rest of it, they're going to put in the riskless version. So just think about it as at time 0, the banks get a bunch of deposits from their depositors, and then they decide what fraction of it is going to go into the risky asset and what fraction of it is going to go into riskless one. So the higher this lambda is, the higher the risk they take. So that's how eventually we're going to use this to measure the risk-taking behavior in bank. So the closer it is to 1, the more risk they're taking. Okay? Don't worry about this. Okay? So what happens is that this is basically, again, just calculating the expected value, right? So you know that a fraction of it you're going to invest in the riskless asset, and the fraction of it you're going to invest in the risky asset. And so the only difference between these two is that if things go well with the risky asset, you receive capital R, which is a higher return. If things don't go well, you only receive 1. You have no return at all. That's why the capital R goes away. Okay, so that's the only thing that you need to get out of this mess of things. Okay, so this is just basically the documenting the actual return that banks should expect at time 2 based off of their investment behavior. Okay, so if you decide on your investment, how much you want to put in your risky asset, at time 2, you're going to realize, oh, my risky asset turns out really well. If it turns out really well, this first line is going to be how much your return is. If it turns out bad, it's going to be the second one. Okay? So that's the first decision that they have to make, how much risk to take. The other one is how much they have to pay depositors as they show up to withdraw. So that's more like the deposit contract. Earlier, we said that they offer 10%. So if you show up at time 1, you get $110, things like that. So this is basically deciding what kind of contract you want to offer your depositors. So if your bank tells you that your saving account is going to give you 4% interest, that is the decision over here. Okay? How much you want to pay them as they show up to withdraw their deposit. Okay? So the last line here basically says that the kind of withdrawal follows some kind of line. So this paper came out in 1988, which means that back in the days, there was actually a physical line if you want to withdraw your money. So within some of the saving and loan crisis in the 80s, people actually stand in line when they want to withdraw. So all the bank runs is very, very visual. Okay? So that's why this paper came out. But now a lot of the models still kind of continue this fashion, because even if you have online banking, okay, just like if Taylor Swift tickets come out on sale, there's still kind of an artificial line. Some people just overslept, right? Or sometimes enrollment of students that they can sign up for classes and then overslept, and then the class fill up. So this kind of artificial line is still gonna be there. So whenever you have the opportunity to withdraw, your place in line has already been determined. And from then, you decide, based off of how much the bank is offering you, whether you should withdraw at time 1 or just wait until time 2. Okay, so this is basically the sequential service constraint that we're talking about over here. Okay, so 2 types of people, right? We already talked about what depositors do. We also talked about what banks do. And for the fiscal authority, basically the government, they realize the return of the risky technology after a certain time. So you can think about this as kind of opaque assets, especially basically the 2008 crisis was caused by highly securitized mortgage-backed securities. So these types of securities are a lot of times, especially when they're new, very, very difficult to decipher and very, very difficult to evaluate. So it takes some time to actually realize their return. So this data over here is how much time it takes to actually decipher it. So this is within time 1. As depositors already start showing up to withdraw, you still don't know whether your risky technology is going to give you good return or bad. After a while, maybe you start to know. So how long we have to wait is measured by this data. Okay? So the fiscal authority, once they know the returns of all the banks, some banks have risky technology giving high returns, some banks have low return, and then at that point they decide how much bailout they want to give to banks that have very low return. Okay? So the budget constraint is very, very simple. Okay? Again, you might not think that it is simple, but all you need is on the left-hand side is the total tax revenue, and on the right-hand side, you have how much they get to spend on public good, which is represented by the G here, and the second part is how much bailout they make. So the higher the amount of bailout over here, this second term, it takes away resources from public good, which is G. Okay? So this makes bailout very costly, and there is an actual opportunity cost that's being considered within this model. Okay? So let's summarize the timeline. Okay? At time 0, every investor, every depositor has some kind of money. In this case, it is $1. They invest in the bank, they deposit in the bank, and then tax is going to be collected. They have to pay some amount of tax. Think about this as you have an income, and the income is taxable. Okay? And then once banks receive all of the deposits, they are going to decide how much risk they want to take. Okay? So this is when they choose how much risk to take. So day 0 is done. At time 1, every depositor is going to realize whether they need the money or not. Right? Are they patient or are they impatient? Or do they have a toothache or do they not have a toothache at time 1? And then the withdrawals is going to begin. So after a data fraction of them has withdrawn, okay, the returns of the risky technology is going to be realized. So this is when people have sufficient time to decipher the very, very complicated assets that banks have invested in. Okay, so the longer the data is, the harder it is to decipher. You can think about those as very opaque assets. Okay? And then after the return has been reviewed, if we are under a bailout regime, this is when bailouts are going to be given to banks. So if the bank turns out to have very low return from their risky technology, they're going to receive a bailout. Okay? And then withdrawals keep going. Whoever shows up at time 1, the banks keep giving them payment. As they show up, they decide how much to pay those depositors. And at time 2, whoever that has not withdrawn at time 1 is just going to withdraw at time 2. And they share whatever resources there are left within their own respective banks. Okay? So that's the timeline of the entire thing. So what happens here is that if there were to be bailouts, and bailouts are only made when bad things happen to the bank over here at this point in time. Okay? So if bailouts are permitted, okay, the government cannot really make decisions until the banks actually fail. Right? If they fail, they know that banks failing is going to wreak havoc in the economy. There's no reason, like there's not really a choice but to bail them out. So that was what happened in 2008. Okay? So banks know that. Okay? And they know when the returns are realized and it happens to be bad, they are going to receive a bailout. Okay? So what happens then is that when they choose the risk allocation at time 1, they are going to take that into consideration. If there is a bailout, risk is going to be higher. If there's no bailout, risk is going to be lower because they know they have to fully take the responsibility if the risky technology turns out to be bad. Okay? So the 3 things that I'm gonna solve for in this case is what we call constraint efficient allocation, which is that if the government, if banks are nationalized, if the government can make decisions for all the banks within the economy, what would they do? What risk level would the government choose for all the banks? So that gives us the most efficient amount, because this is kind of like you have a benevolent dictator and they make the best decision that makes everyone the happiest. So if we're able to achieve this level of welfare in the end, this level of outcome, that's the best outcome that we can ever achieve. Okay? So on top of that, I also saw two different outcomes. One is if we allow bailouts to happen. So basically at this point in time, the government is going to decide how much bailout to pay for each of those banks that have bad returns. And then artificially, I take away the ability of these kind of bailouts to be made. Okay? So we know that this is kind of like a hypothetical environment, because we know that in reality that's not going to happen. When banks fail, when they get into trouble, usually the government has no other choice but to bail them out. So this is just saying that if there is some kind of real restriction that no bailouts can be made whatsoever, okay? If banks fully internalize that belief, what would they do? Okay? So now we're going to compare all these three outcomes. Okay? Ignore all these. This is the outcome. Okay? So what happens here is that I compare the welfare. Okay? Welfare meaning the utilities of all the all the depositors in the entire economy. Okay? Coming from their own deposits and also coming from public good. Okay? Because public good gives some kind of utility. You have public schools, you have infrastructures and all that. Okay? So what happens here is that we know that bailout sometimes gives higher welfare, and sometimes restricting bailout can also give higher welfare depending on the situation of the economy. So these three diagrams show us when bailout regime is actually better than restricting bailout altogether. So all these shaded regions are the parameter values that tell us that if we were to allow bailout, the economy can give a higher welfare as compared to no bailout at all. So what situation is that? So P is the probability of the risky technology giving high returns. So if the risky technology becomes more and more attractive, okay, we want them to take the risk. So allowing bailouts generally would give a higher welfare. So that's why when P is generally high, you see all the regions become shaded. Okay? When P is low, they're not really shaded. So zero bailout is better. Okay? The other thing is also, what is the actual return when the risky technology is good? Going from 15 to 18 to 21, if we keep increasing the benefit of risky technology, you see that the shaded area becomes larger and larger, which also means that bailout is actually better. Okay, so bailout does give benefit in this case, because bailout allows some degree of risk-taking, and risk-taking is good when the risky technology is very attractive. Okay? So the last thing over here is the data, how long it takes to decipher returns. Okay? So that is nonlinear. You will see that when it takes very quick time to decipher the returns of the risky technology, bailout is good. When it takes a really long time, bailout is also good. But in the middle, it's not that good. We want zero bailout. So why is that? So if we take a cross section, a horizontal cut over here, and expand this out, okay, what happens here is that we can see the orange line is when we allow bailout, what would happen. The green line is when we don't allow bailout, what is going to happen. And then the blue line is the constraint efficient level. So let's focus on this risk-taking table. Okay? If the most efficient level of risk is this blue line. And you can see that bailout, if we allow bailout, banks are going to take more risk than is necessary, more risk than the efficient level. But if we eliminate bailout, they become overly conservative. Their risk-taking level is below the efficient level, which is why even restricting bailout altogether is not the best thing. Okay? So two things are happening at the same time. the longer we have to wait, actually, let me not explain that. So this is basically the main result over here. And now I'm gonna talk about the two potential policy tools, okay? So we know that allowing bailouts can causes banks to take too much risk. But if we restrict bailout altogether, it's also not good because banks are too conservative. So what is the best of both worlds? The first thing that I suggest over here is that we keep allowing bailouts, but we should tax the amount of risk that banks are taking. So there are many different ways that this can be done, and Koche Lakota, which is the board of governor of the Minneapolis Fed at some point in the 2010s, he suggested that we can introduce a security that the security payoff is tied to the aid or the bailout that eventually banks are going to receive from the government, okay? And the price of that security is what the market thinks about the risk-taking level of the bank. Okay? So if you think that a bank is going to have a high chance of getting government bailout, okay, the price of the security is going to be higher because the payout of the security is tied to the government bailout that particular bank receives. So based off of this market value of the security, we can impose a fractional tax on the risk-taking level of the banks. So what I show is that, don't worry about the first part. The second part is if we still allow bailouts, and as long as we allow the government to also tax the risk-taking level of banks, we are able to achieve efficiency. At least in this model setting, okay, we are able to achieve the constrained efficient level of outcome. All the banks are going to take the appropriate amount of risk, which is the constrained efficient level, and they're not going to be overly conservative because we still allow bailouts. So that's the most efficient outcome. Okay, so one of the suggestions, this is the most realistic option if we were to tax the risk-taking behavior. Okay? The second policy tool is to have some kind of commitment. So this is a little bit less realistic because we know that when banks fail, okay, you kind of have to bail them out fully. Okay? Prevent them from failing, otherwise it's going to cause a big recession, especially when the banks are very big and very substantial within the economy. So if we are able to come up with a committed structure of bailout, basically saying that if this happens, what is the amount of bailout? This happens, what is the amount of bailout? And credibly commit to that structure, we can also achieve the efficient outcome. Okay, so again, this is the second, I studied some kind of bailout commitment in the past, and this is related to that, and it's like kind of inspired by my previous paper. Okay? So some of the things can be a written law that's passed or some reputation in the past. So if you keep following very, very painfully this committed structure, maybe banks will start internalize that this is the structure going forward, and we will be able to, in that case, we will be able to achieve an efficient outcome as well. Okay? So those are my main findings, and those are the two policy suggestions that come out of this paper to regulate banks. Okay? I think I overtime a little bit, I'm sorry. Thank you.
Perfect time. Maybe a few quick questions for those who have a little time to wait.
Yep.
I have a question. I probably have five, but I'll ask one. Am I correct in, you're making an assumption when there is a bailout, that banks are seeking short-term goals, short-term profit, because they have the risk of going under, even though the depositors will be compensated. The bank will be out of business. So by saying that when there's a bailout, they're going to be riskier, it seems like you're assuming that they're focusing on short-term profit maximization, and vice versa. When there's no bailout, they become conservative, so they're more apt to be looking at long-term profit maximization. Does that make any sense?
In terms of short-term versus long-term, I don't think this model is sufficient to capture that because it is the fixed amount of time, and then after that is kind of the end of the world. There are other models that give perpetual decisions of banks that study this beyond pre-period, like basically infinitely many periods, and every period they decide what portfolio that they're going to invest in within that period going forward, and that might be able to study some of the more dynamic decisions. So whether it's short term versus long term, whether they only take risks, higher risk only for a few periods, and then they drop down or not, and that kind of model can probably capture that a little bit more. But I don't think in this case it can answer that question. Okay. Yeah.
This isn't a trick question, but do you know, has the FDIC always paid out, made insurers whole, even if the amount is above the limit, the 100,000 to 250,000? Because they always make a buyout deal or a merger, and the depositor is unaffected.
Depositors have mostly been unaffected by most of the bank runs at least in the United States. Mostly because of all the, I guess, the mergers that have been facilitated by FDIC. So as far as FDIC is concerned, they tried their best to do this. In the literature, we call that private sector bailout, or sometimes it's bailed in, and depending on who you're asking. So private sector bailout in that sense is kind of more mergers and acquisitions. So a larger bank is going to swallow the smaller bank, because a lot of times, especially when it's penny-based bank run, as long as you have this injection of cash flow temporarily to get the bank through, they are actually profitable in the long run. So when these big banks come and merge and swallow them, then depositors usually is unaffected. Yeah. So for most cases, I think it is unaffected. In 2008, there might be a few cases. I'm not sure.
Yeah, I don't know.
Yeah.
The myth always seems to be that depositors are always made whole, but I don't have any evidence to back that up. But that's just
in terms of the example, Silicon Valley Bank, eventually they were able to insure all of the deposits of all of those startups. Yes. Yeah.
First of all, I thought that was great. It was very clear. Thank you very much. But I do have a question about the taxes at the end. Am I right to think that the Pigouvian tax, the first one, the best one, would be sort of the same as a tax on the marginal damage at the optimal?
Yes.
Okay.
So,
and then the second solution, would that be like a quantity constraint compared to a Pigouvian tax?
So let's look at the second one first. It has to be some kind of structure. So in the mathematical way, the fixed structure would be that for this amount of risk that you're taking, this would be the potential bailout amount. So it's like a function that we're trying to commit to. So if you translate to the practical world, it should have some kind of structure. The more in detail the structure, the better. But again, this kind of commitment is still very, very difficult. And then going back to the first one, it is kind of like there's this externality. Taking too much risk is like pollution that the banks don't internalize. So we tax them, we force them to internalize this negative effect of risk taking, because if they go down, it's going to take away resources from public funds. So by taxing them, we kind of force them to internalize that kind of externality that arise. Yes. So that's why it has to be a fractional tax.
Yeah. So then in either case, right? You're still going to have to estimate those functions, right, to be able to figure out what's the optimal amount. And so then I think this relates to Bob's question actually, and it might be the answer. So then when you add uncertainty, so if you had some time that you have to worry about other than the 2 periods or the 3 periods, then the uncertainty would matter in terms of which one you chose that would be optimal, right? Because the deadweight loss would be different for one versus the other. Does it work? I'm just wondering whether it works that way, like with the standard Pigouvian tax, with your model, or is it because it's a 3-period model, there's no worry about the uncertainty?
In terms of this environment, the only uncertainty is coming from the risky technology. So yes, it is not rich enough to answer that question. Okay. But at least what is suggested here is that in reality, no matter how long or short period we're seeing, that kind of qualitative outcome is there, because banks know that they can take advantage of bailouts, they're going to take more risk, and by taxing this, they have to pay a cost for based off of the amount of risk that they're taking. So it is like a structure, like income tax. So you always pay like 10% of your income, for example, and then you have kind of different structure. So in this case, you can base it off of the security that's tied to the government aid. Then the higher the price of the security, that means the market thinks that the bank is taking very high risk, and then you can again have some kind of function of, if the price of security is this, how much tax you should pay because you are taking this
So then
amount of
the
risk.
bank internalizes that cost.
Yes.
And then behaves in that way, so
Yes.
the optimal.
Yes.
Okay.
So even though they know that taking a lot of risk, they can take advantage of bailout, by taking a lot of risk, you also have to pay this tax.
Got it.
So that balances out the two effects.
Got it.
And then you, ideally, in the ideal world, you can get to the efficient level of risk. Yes.
So how does risk get assessed? It's easy to say you have two things.
Mm-hmm.
One is riskier than another.
Mm-hmm.
But if there are multiple institutions that need bailouts,
Mm-hmm.
how do you decide, who's the market that's deciding what was riskier than another? And then where's the formula for the level of bailout that you would associate with these various levels of risk?
So in terms of bailout, it's usually when banks start to get into trouble, and then the FDIC will come in and decide how much cash flow has to be injected in order for them to have enough liquidity to pay their depositors. So that amount comes from their balance sheet at the time of failure. And in terms of the risk, there are many ways that we can tax risk and many ways that we can assess risk. One is have a regulatory body that looks into the books and the assets that all of these banks are holding and decide that. And that is very costly, which is why Koche Lakota suggested this free market way of assessing risk, which is to invent a security that ties, the payout of the security is tied to the government aid that is eventually going to be received, so that we let the market decide. Of course, this is also not perfect because we are assuming that the market has all of the information about the bank to assess the risk. Right? But that is the more decentralized way of assessing risk of all banks within the economy, which is like 7,000 at this point in time, which is very costly to regulate if you were to have a regulatory body to go into and look at the books of every single one of them. So this is like, let's say you have 3,000 banks, you have 3,000 different securities. Each security, the payout is tied to the aid that all 3,000 banks are eventually going to receive, and then you look at the price of those securities, and that's what the market decides. The market means that whoever that wants to buy these securities, just like a stock, just like a bond, the prices of bonds are going to be decided by the market. It means how much people are willing to pay for it. So the more people are willing to pay for it, that means they expect that these banks are going to receive very high bailouts. That means that they believe that these banks are taking too much risk. So this is a kind of a less costly way of evaluating the riskiness of all banks at all times. And that's the suggestion. And we can tax these banks based off of these market values, the market decision. Yeah. Mm-hmm.
Today the tax is just based on the insurance of the deposits, right?
Yes.
So couldn't you look at all of the loans, look at the quantitative risk, let's say high, medium, and low, and then just go back and have the insurer charge a different rate based upon the high, medium, and low risk. And ultra high risk, we no longer insure your deposits.
Yeah, so that is
just have different rates, and it would simplify and not create another instrument.
Yes, so that is also like this. That's equivalent to taxing risk already. As long as you're putting all financial institutions into different boxes and charging them different amount, that's the Pigouvian taxation on risk that's equivalent to this, at least in the theoretical setting. So the implementation of that, with that, you will have to look into the the analysis of the assets that all of these banks hold, which also can be costly because at all times there are so many financial institutions. So maybe the categories will alleviate some of the costs because you only do ultra high, high, medium, and low, but still there is some kind of cost related. And then the more broad-based, the less fine-tuned the risk categories are, the less effective the Pigouvian taxation is going to be. So if it will still be effective partially, if you can be very, very fine-tuned, like the most fine-tuned, of course, is the idealistic world that we were looking at, then it will be perfectly efficient. But some kind of differentiation would bring us closer and closer towards efficiency.
Yeah. But there's a huge cost to get it.
Yes, there's a huge.
That's perfect.
Yes. So the free market version is the least costly to get the most fine-tuned version of this kind of tax structure. Yes. Yep.
I just have a question. My local bank, the people who work there have said that Massachusetts provides additional insurance on top of the FDIC insurance. Is that correct?
I'm not sure about that.
Yes, it is correct.
Yes.
Okay.
DIF, Depositors Insurance Fund.
Because apparently it's not limited in Massachusetts. How
That's
much can be insured,
also correct, I believe.
which is good news.
Yes.
Massachusetts.
Don't
Yeah.
It's really good news if you exceed 250,000.
Oh, yeah.
Well, the FDIC insures more than 250 if it's a joint account.
Right.
I mean,
Yeah, if you have joint
It's
account, then
500,000.
it becomes 500,000.
so
Peter
that
has.
covers most people.
Would you be able to make almost program to almost outline this entire, I guess, model to, I guess, estimate your risk, your probable outcome, and your probable loss, almost?
Sorry, again?
Would you be able to write a program almost to outline this entire model that's basically going to show you your possible risks, your possible outcomes, and possible bailouts, but also like accounting for the insurance and stuff?
With
Yeah.
sufficient amount of data, you can. Okay, so that is a good project. That's something that I've been working on too. But the data is very, very skewed when it comes to bank failures. Every year, on a normal year, a handful of banks are failing out of 7,000. So it's a very, very skewed set. And because the data set is so tiny, because you only have to focus on the ones that are failing, it gives us not a lot of information about this kind of prediction. But if, again, hypothetically, if we have sufficient data, anything is possible with AI. Yes.
Thank you.
So with these papers that you referred to, are some of them, maybe all of them, were they simulations?
What paper?
The papers that you reviewed in the literature review?
Oh, reviewing the
Were
literature.
were there like a bunch of simulations on some of those, or?
Some of them are purely empirical papers.
Oh, they are, so they used,
So the 2014 effects of bailouts on bonus and compensation scheme, that's empirical, and bailouts on risk-taking in firm, that's a theoretical paper.
a theory, theory.
Yes. And then these two, I think, one of them is a structural calibration. So they have a model and they try to benchmark the model
Yeah.
to estimate the best they can the data that we observe. Yeah.
So Professor Khai, I'm just going to do a formal thank you, since I promised Jack an hour. So on behalf of everyone, thank you so much for translating your abstract algorithms and density into colloquial language. Much appreciated, and thank you all for coming. And please stay.